This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
Remember when lifestyle centers were all the rage, right? Like little mini lifestyle centers. Each one of these things have to have their own kind of ecosystem. You have to be able to create that hype and sustain flow of folks to the asset and keep them engaged. Otherwise, it doesn't matter how good your dirt is. You're just not going to bring the folks there.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. As a former New Yorker, I can tell you that market in terms of real estate has its own ecosystem. That said, if you can figure out how to do real estate in New York, you can pretty much figure out how you can do it anywhere on the planet. Well, our next guest knows all about this. He and his team have closed well over 1,500 deals, leased more than 1 million square feet of commercial space, and has effectuated more than $1 billion in transactional real estate. Now, during this time, he shepherded the completion of transformative projects that have reshaped New York City's commercial real estate landscape. Now, through discipline and building a lifelong learning mindset, our next guest has the expertise that allows him to run a very large real estate empire. Now, whether it's be residential, mixed use, office space, defaulted notes, or even lease ups and ground up development, he and his team have pretty much done it all. He is the CEO of Prendamano Real Estate, or PreReal, and he's also the host of the PreReal podcast. So with all that, I'd like to welcome James Prendamano to the show. James, buddy, thanks for coming on, man.
Agostino, thank you very much. Appreciate the opportunity to be here. Looking forward.
Yes, me too. Now, guys, if you think what James has to say, you can reach him via his contact page at PreReal.com. Okay, James, go ahead and tell the listeners a little bit about your journey.
Sure. So I've been in the game literally since I was knee high to a grasshopper. Mom started a small boutique brokerage here in Staten Island many, many moons ago. So I've literally been around it for as long as I can remember. I watched Mom, kind of carve a path doing some of the first large-scale commercial transactional stuff in Staten Island as a woman, especially at that time on the island, was a challenge. But she's a fierce woman, and she made her mark. And as I came into the business, I saw an opportunity to start leveraging some technology. I mean, when I first started, it was, like the old school stuff. When we first got our modem and the dot matrix printers, it was like revolutionary stuff, man. Like we started with the books. Anyone who was a broker at one point in their career knows what I'm talking about. We had the actual books that we waited for every 2 weeks to thumb through, and our prospect cards. But the business was ripe for disruption. And being in Staten Island, we had an opportunity to work on some really neat large-scale commercial projects. And as things kind of take on a life of their own and your base grows, we did a bunch of consulting work for some of the smaller developers, and that grew into the bigger developers, eventually for Goldman, for BFC Partners, for Iron State Developers, some of the biggest and best out here. It was a unique and a neat opportunity for me to see really every side of the business. And what I learned early on is this is a cycle, and there's trends. And as the commercial is performing, oftentimes the residential softens up and vice versa. So it was important for me to learn all facets of the business and to be able to execute as the market dictated the opportunity. And that's kind of what we've done. We've been really a tenacious group of workers that have hit every angle in the business, and fast forward 25 years, here we are and doing our own thing. We launched our own brand, a real tech forward kind of opportunity where we can leverage all the tools that are available in the digital toolbox and take that out of like the deal maker's purview. And for us, we saw an opportunity to put the parent brand in these smaller markets for the investment fund. When you have contacts in markets, Agostino, the locals get the deals, right? I've got my guys and people have their guys. And we felt that if we can take all of the things that deal makers don't like to do out of their workflow, centralize that stuff, take local brands that needed that kind of influx of talent and capital and technology, we became locals. And through that vehicle, we started getting local deals. And the ultimate end game has always been to be on the ownership side of things. And that's how we were able to transition into different markets and do some neat stuff. So
nice.
That's how we got here.
Nice. And I think that experience with that past company, working with family, the family-owned business there, it sounds like it got you exposed to many different facets. Like, I think, of course, aside from the commercial stuff, which we talked about a little bit in the green room too, so the residential stuff you mentioned too, but it sounds like other aspects like development and lease ups and all those other things, right? I mean, I think that's one key advantage that you have, that you're exposed to all these different types of real estate asset classes.
Well, if you didn't evolve back in 2008, you were in trouble. So we quickly learned the ins and outs of defaulted notes, established contacts with the banks, and became one of the brokers that was trading the larger projects on these defaulted deals. We had the experience of the ground up lease up on the commercial side and on the residential side in a multifamily capacity. So we were able to show underwriting how it would work. If it was a condo project, the sellout back then, there was no such thing as a condo project anymore. Everything had to underwrite as a rental deal. But because we had that experience, we were able to kind of take the whole package. Okay, you have a defaulted note. Here's how we sell it. We build the packages internal, and we go bring in the development team. We sold many, many, many notes, 2008 right through 2011 or 12, and reposition those projects into really successful developments for investors over the years.
Now, I want to talk about the New York stuff. We talked about it in the green room about that. But before I move on to that, do you think you're going to see a repeat then of the 2008, and not in terms of the circumstance that caused it, but more along the lines of the default and the whole notes, the note scenario you just mentioned a second ago? Like, do you see banks trying to unload all these notes basically to private investors because they just want to keep them on the books? Do you see that happening again?
I think it's going to be worse. I think that this is going to make 2008 look like a walk in the park. Now, not every market feels those hits the same. There are some markets that have far more exposure than others, but we've been screaming about this for a couple of years. We think that there was a perfect storm coming. COVID just lit the match, and here we are. We think it's going to be amazing opportunity, but also some tough years out there for folks if they're not positioned the right way.
Oh yeah. I mean, listen, it's no one ever wants to see people get hurt, but there will be a lot of people getting hurt in this next down cycle that we're, I guess technically we're in one right now, right? By being we talked a little bit about that. It's going to get a whole lot worse before it gets better. That is for sure. So one thing we talked about was the whole situation in New York City. Now, as a former New Yorker, I guess it's near and dear to my heart. There's certain elements of New York that no matter, even if you live there for only a few years, it kind of like never leaves you, right? So it's certainly very disheartening to see this mass exodus. What is your general thought around what's happening in that market in terms of, maybe let's talk first about the residential side, because I think that with the COVID thing you mentioned a second ago, that caused a mass exodus, but I think it's since moved on to the more the commercial side as well since then, right?
Hey, Agostino here, and I would love to connect directly with you.
text the word books to 844-428-1344 to receive weekly book recommendations from me.
Yeah, so it happened in phases. So the first phase on the residential side was folks that had the means to leave, that had the second homes or the ability to pick up second homes, were doing that. What we're seeing now is as companies that traditionally have pushed back on the remote learning thing, the institutions, right? They've to kind of come up through those companies, you had to be at the office early, first one in, last one out. That's how you moved up through the ranks. That's also changed. And what we're seeing now is some of the big companies pull up stakes also. And that's candidly, it's scary. The legislation here, we've been candid about it. I'm a New Yorker through and through. I love it. I always have and I always will. But as an investor, you have to look at and you have to read the tea leaves and you have to start making those tough decisions where when legislative risk started to be in the top 1, 2, or 3 items on any analysis that we did, you have to start paying attention there, right? Because no matter what you do, if you're on the wrong side of the movement, if you will, at that particular time, there's not a whole heck of a lot you can do about it. And that is now translated, and you're seeing significant amounts of cash leave New York. We talked earlier a little bit about the opportunity zones. This is a great program. It gives folks flexibility, and New York decoupled from the federal benefit completely. They don't recognize it. So we're seeing huge amounts of money just pick up and relocate to OZs throughout the country. And we had touched on, there's some tough OZs. There's some places that you look at and go, I don't care how much money comes in. This is a 30-year project. But there are other places that are like unbelievable opportunities, and people are taking advantage of it. At the end of the day, Agostino, it comes down to, is it worth the risk? Right? That's how you measure your investments. When you boil it all down, is it worth it? And unfortunately, more and more folks are deciding it's just not worth it anymore here.
Yeah, which I think is what led to the mass exodus of people just picking up and leaving, going to Florida. Florida was the usual suspect, I think, because many New Yorkers had second homes down in Florida. They just moved down there and they don't come back. I have friends that personally that did the same thing. Numerous friends from New York that left, and now live in Miami or somewhere around there. So, yeah, I mean, that's the thing. But now then we talked a little bit about the commercial side of things too. I mean, it sounds like office space was already a challenge to begin with, just in terms of where it was. But now now we're talking about crazy vacancies at this point, right? To your point, why have people come back to work? It doesn't make any sense to take on that expense. So
it's office and it's retail. Again, there was a perfect storm with COVID, of course, and the remote working. And there's a better way to do this. A lot of people figured that out. Like, we can take a discount in our pay and have freedom in our lives. And the companies are supporting that. But then on the retail side as well, and this goes way back, again, we talked about this in 2006, 2007, 2008. As technology began to disrupt retail, the retailers started to question, is it worth having those flagships with the crazy rents? Is it worth having that exposure when for that same investment, you could reach your consumer in a very direct and a very intimate way on their phone? Of course, Amazon comes along and really turns this thing upside down. And now you're able to get product without having to even go out and physically visit the stores anymore. So on the commercial side, it's not just the offices, it's the retail also. People are opting for less expensive places to locate their flagships, and they're utilizing, the last mile stuff to get the product into the consumer's hands, and they're investing super heavy in the digital space.
Yeah, and we talked a little bit about the retail stuff. So I know that you guys have inventory, you guys have product outside of New York City, outside of New York for that matter. A lot of it, or some of it, is actually the retail stuff, right? Like malls, shopping malls, that kind of thing, right? Maybe tell us a little bit about some of those projects you're working on.
Sure. So again, it comes down to the risk and the return. If you're able to pick up shopping centers in New York, still the rates are fiercely competitive. If you're going to be in the mid fives or sixes, or if it's a single tenant asset, you could be 5 or sub 5 in some instances. And you can go out to other locations where you're picking up real estate that maybe it's 50% vacant, maybe it's 70% vacant, in need of some capital, some repositioning, but you have the retail contacts, you have the experience, you know how to read the demographics, you understand if corporate leasing is viable there. Cap rates don't rule real estate in those secondary and tertiary markets like they do in the big cities. So for us, this became a great way. You know, we're elbow grease investors, right? We're folks that like to step in and do the work to turn the asset around. That's where the most upside is. And we're not afraid of that kind of work. So we generate those efficiencies, and we're able to acquire assets at a fraction of the cost in New York. You're able to still get the same signatures. Yes, the rents are lower than they are in New York, but it's not a 1-to-1 ratio, right? The acquisition and the buy-in is so significantly cheaper in these other markets that you're not afraid. In an inflationary period, people will argue, stay away from commercial leasing. We don't want to have fixed rates where increases on the single tenant assets, right? Are you getting 5% every 10? Maybe. Are you getting 2% actually per year? Probably not. You're certainly not getting 3% a year. And inflation now has far outpaced that. So there are those that would argue stay away from those types of investments. But when you have that kind of upside, it's worth it, right? Because you don't have to worry about that dollar lock-in because you're not at a fixed cap of 5.5%, or 6%. So the upside is there. And that cash flow, when the banks turn the spigots off, and that's coming, right? Like I believe that's absolutely coming. And you still have those rental properties performing, it keeps you liquid and it keeps you in a place where you can go out and do the most damage, right?
Yeah, that's right. It sounds like it's still worth doing stuff. I mean, not New York City proper, but the secondary, tertiary markets, then, right? I mean, it sounds like you guys are still very active, even in New York, right?
Yeah, it sounds like. The secondary and tertiary markets from any major city are, in my opinion, the place to be now. So there was the anomaly, and we talked about this at great length. When the markets turn, those secondary and tertiary markets typically get slaughtered, right? We saw this in Florida last go around. But there has been such a permanent relocation now that secondary markets became primaries and tertiary markets are becoming secondaries. So we feel that there's a shift here, and if you're in the right secondary or the right tertiary market, man, you're going to clean up. You're going to do really well through this.
Yeah. So it's really just trying to track the trends and seeing, like just like multifamily. It's the same sort of thing. Where the movement's taking place. Where are the people migrating to? It's migration is really the key aspect here, right? In terms of figuring out where those transitional areas are. Right. And then possibly take advantage of these commercial type of deals. We're able to get in, try to find a deal, try to get a deal. And of course, do what you said, turn it around, fix it up. Right.
Absolutely. If folks have relocated there.
It's no easy feat doing that, by the way. It's no easy feat doing that. It's just, there is a mall, a shopping mall. I should pass it on to you maybe after this call here. The last 2 times since in Sarasota, it's got to be 30% occupied. You know, the rest of it is all just closed up, right? A lot of potential, but I mean, as I'm walking around there, I can see this thing needs a whole ton of work. So that's not for the faint of heart. Doing that type of work is not easy. It's certainly not easy.
It requires super flexible zoning, something else that we look at on the way in. It requires a lot of capital. It requires staying power, vision, and in some instances, it requires cooperation from the local electeds or delegation or zoning boards, whoever it may be. It certainly is not for the faint of heart. Look, it's hard to find the deals. It's hard to execute the deals. This stuff it's not easy. We call them TikTok investors, where you see folks talking about trading in their 9 to 5 and now they've got 1,000 doors and how, this is an ongoing process, right? And as the markets change, you better be sure that you're in the right product on the debt side and that you've got the right reserves and you're able to execute your plan when things get tough, because it's a cycle.
Yeah, I think many of the people that are getting into it or have got into it, say the last 3, 4, 5 years, they have no idea how tough it could possibly be. I want to take a pause from today's show to share something that I've been encountering. As I speak to many investors, there's this concern, and the concern is centered around the inflation we've been experiencing and the devaluation of our currency. Now, we've seen some of the highest inflationary periods over the past 30 years. That's up over 8%. Economists actually believe that inflation is closer to 20%. Some say it's even more. Now, what does this mean for you? Well, it means that money that is sitting in your bank account or self-directed IRA that's not invested in physical assets that hedge against inflation are losing buying power. That means that every minute, every second, that dollar is becoming less valuable. You see this every day. You see this in the groceries you buy, the gasoline you buy, everyday items that you're buying on a daily basis are becoming more and more expensive, and you're using a less powerful dollar to buy these items, meaning that dollar is losing value if it isn't put into a property that produces cash flow, just like real estate does. Now, our team here at Bulletproof Cashflow has put together a series of weekly webinars that cover real estate investing like multifamily, net lease, and real estate development. Now, these are purely educational webinars. In these webinars, we talk about why real estate offers a powerful opportunity right now and why it makes sense to invest in these assets today. So if you're interested in real estate or want to have the opportunity to get involved as a hedge against inflation yourself, I encourage you to go to bulletproofcashflow.com/webinars. That's bulletproofcashflow.com/webinars. Now you go there, these webinars are 45 minutes and they cover different topics every week. We go over the things you need to know to avoid some of the common pitfalls when it comes to investing while getting you prepared to invest your paper dollars into a real physical asset. Now, if you can't make the webinars, just go ahead and register and we will send you a recording that you can watch at any time. And by the way, these webinars are entirely free. There's no cost to you. This is just something that we do to educate our folks out there. So if you're enjoying this episode, please like and subscribe to Bulletproof Cashflow. It helps the channel tremendously when you do. Now let's go ahead and get back to the show. I think it's going to get really ugly if you weren't positioned properly. If you had never been through a recession before, it's going to get real ugly. It's going to get real ugly.
It got really scary for us. Not only do the passive folks not know how hard it's going to get, the syndicators don't know how hard it's going to get. Mm-hmm. When you start digging and, you've never seen a pitch deck that doesn't look great, right? Because that's the intent of a pitch deck, is that every deal is a score. But if you know what to look for and you start pulling these things apart, there's some wicked exposure in there. There is, and some of the syndicators, if you press them, not all, many of the syndicators are brilliant. They've had a lot of success. They have a track record. They understand what's coming. They've been there before. They know how to endure. But many of them have not. Many of them have been doing this for 2 or 3 years, and they're now on the GP side. They're running the show. They're placing the money that the investors are entrusting with them. And they just genuinely don't know what's around the next corner. And it's tough, man. It could be a tough game.
Yeah. I think that's why partnering up with someone who knows what the hell they're doing is going to be absolutely critical. I mean, I certainly still believe taking this worthless cash that's being printed into oblivion and put it into a hard asset is definitely where it needs to be. Finding the right vehicle is the tough part. That's the tough part. That's always the tough part. Yeah. So getting back to the mall situation then, one thing you didn't mention was trying to get the actual tenants to move in, like the actual, obviously in a mall, aside from fixing it up and management and zoning and all that fun stuff, finding the actual tenants to move in and take that asset or take that spot for, 5-10 years at a time. I'm assuming you guys handle that part too, right?
Yeah, we have that. That's really what launched us into at least the commercial investment side, acquiring these shopping centers. We have extensive leasing background. We started as leasing agents. This is what we did. So you make the contacts, you understand what they're looking for. And as you noted, that's not easy either. Finding the tenants that have the right credit and the balance between credit and mom and pop that are expanding at that time in that market, and then telling the story of why your asset is the best one in market and why you deserve to have them in that asset. That's where you win, right? It's making sure that when they get into that REC, that the picture you have painted is clear and comprehensive and concise, and they understand why you're presenting the asset that they should proceed with. It's not easy.
No, it's not. I mean, we lease out space like this as well. I hire local brokers to find us those sort of national tenants is what we're trying to attract. But I'd say that it sounds to me like in a shopping mall situation, before you get a Foot Locker, who usually gets one of, I don't know the technical term, but they get the smaller spaces, mainly in the corridors, but you need an anchor. They want to know, is there a Macy's? Is there a JCPenney? Who's the anchor there? And if there's no anchor or there's a weak anchor in there, the smaller stores are not going to show up. Is that accurate or? Yeah.
So without a doubt, you need to have the right anchors that speak to the local demographics and that will have a halo effect, right? That is going to support those secondary tenants that you bring in. You've got co-tenancy matrix to deal with. There's all sorts of complications. You've got to ladder the deals properly to make sure they don't end up with these things all expiring at the same time. But beyond that, Agostino, I think one of the biggest challenges that folks are facing now with these malls, what do you do with them? I'm not sure that retail as a standalone concept works anymore. I think that you have to really get creative. I know some mall owners that have bigger portfolios are exploring now how to rip the roofs off their malls across the portfolio, right? These are like out of the box things that we have to start contemplating because the traditional enclosed mall is in trouble. It's got to be an engaging, interactive experience. I think you have to mix not only retail and food and beverage. I think you have to mix in residential. I think you have to mix in some office. I think you have to have an entertainment component. It's got to become everything. They've got to become almost like, remember when lifestyle centers were all the rage, right? Like little mini lifestyle centers. Yeah. Each one of these things have to have their own kind of ecosystem. You have to be able to create that hype and sustain flow of folks to the asset and keep them engaged. Otherwise, it doesn't matter how good your dirt is. You're just not going to bring the folks there.
You know what? That's a very good point because I was actually at a mall just this past weekend in Michigan. And there was a mall that I hadn't been in probably 10, 15 years, probably longer than that. And I happened to have my son with me, and I'm walking around this place, and I started explaining to him, with the knowledge I have, clearly not the same knowledge as you, but it's but I can certainly tell what's not a national, what isn't national. And I know that there used to be a national there, and now there's, Jim's peppercorn steaks frozen. Here we go. It's like, what is that, right? It's or there's a vacant. It's just vacant. Or a jewelry store that had massive square footage going into a quarter of the size now. And I'm pointing all this out to my kid, but one thing I didn't know is how do you fix it? And I think that what you just pointed out is the perfect way to do that. I just don't know that. Would it work in a place like a suburb of Michigan and Southfield, Michigan? I don't see it happening up there, but maybe in a place like Florida, absolutely. In warmer climates, so there's a lot more vibrant migration path taking place. Sure, I can see it happening. But yeah, to your point though, it's tremendously expensive. It's not easy to do, right? You're taking malls I'm assuming from the 60s, maybe the 70s, and pouring in millions of dollars just to clean it up, let alone build something.
You're redefining it. It's not just a mall anymore. So right. I think each market has its own. Again, each property has to tell its own story, and it has to be reflective of the demography. You have to tap into who those people are, what they want, how do you engage them, capture them, keep them there, and then balance it out. Again, education, medical, food and beverage, traditional retail, mom and pops, all of these things are a critical component. Each one is a critical component in building the experience. You have to have an experience. And I do think that there are different markets, not just unique to the warmer climates, though that has its own, certainly it's got its own benefits. But you have to have that compelling story and be best in market. So it's going to be an interesting couple of years, brother.
That it is. And I think you mentioned something too about single-tenant net lease. I think you talked a little bit about that. You're doing some of that stuff as well.
Sure. We've done, again, on the brokerage side, that's been kind of the in to everything for us. But we've done, you name it, we've done the deals from the banks and the drugstores, right up and down the line, the fast food chains, the coffee shops. Typically, those trade at the much lower cap rates. There's not much room for upside unless you're acquiring the land, right? So one of the things we do when we go to these kind of small town USAs is we pick out those key corners, those signalized lights, the signalized corners where there's the most traffic. And you'll be surprised. Sometimes you can find those corner pieces at a fraction of what you think it could trade for, because you understand at the end of the day what a tenant will pay if you build a shell or if you just do a straight land lease. So I think there's a lot of opportunity there as well, but you have to be on the development side. There's not much room when you're just trading caps. It's great cash flow. It's a great piece to have as part of the portfolio. But for us, again, being elbow grease guys, we like to get in on the ground level, find the asset, put the plan to it, get it approved, do the leasing, and then you can trade it at a cap rate.
Interesting. So you're more bullish on building that a Burger King or a Dollar General as opposed to just buying one at some crazy cap rate, right?
As part of the portfolio, right?
As part of it. Okay.
As part of it. There's definitely a place, man, for cash flow. As again, the traditionalists will argue, don't lock in at a fixed rate. You're technically losing money every year. If they don't care if the rent's $100 a foot, if inflation's at 10% and your increases are at 3%, you're technically losing 7% on your investment. But you have cash flow in a time when nobody else does. That's valuable stuff. So I think that there's a place for a little bit of all of those pieces. That's how you build balance, man. You have a little bit of everything, and just like when we were brokering and jumping from market to market as things got hot and things cooled off, it's really no different on the investment side.
Yeah, absolutely. Yeah. So one thing that we've seen with our acquisitions on the net lease side is that I think earlier in the year we saw cap rates for very short-term lease stuff still in the high fives, low sixes, 6%. It's ridiculous. Now we're seeing them come back to somewhat normalcy, with the exception that now the money is more expensive too. So but the gap between them has certainly become a little more palatable, right? And so now it's worth doing the deals. But geez, man, I'll tell you, it's it's still tough out there to find decent deals. It's still tough. They're out there. It's just hard to find.
No doubt about it. I think the rate certainly is a reason for the pricing coming down. And I think also, again, the traditionalists, kind of pulling back against those fixed increases in an inflationary period. Unless you have CPI increases, which you're not getting in a corporate lease, it's just not happening. Right. It can be perceived as not the most efficient place to have the money. But again, for us, we think that there's a significant place in the portfolio for it. We're certainly not running from it. And when we can get in on the ground up, literally, that's what we're doing.
Nice. Good. Well, we've got a lot of stuff here today. What would you say if for someone listening, what sort of bulletproof advice would you have to offer them?
So I think it has to be centralized around the time that we're in. I think that we're headed into what will be the greatest buying opportunity of our lifetime. But with that is immense risk and immense challenge. So I think that it's critical to understand truly what your goals are, understand what it is really that you want to get out of your investment, and then go find the place, the partner that's aligned with that vision, that's aligned with your goals. Be focused, be very intentional with your investments over the next few years, because again, it's going to get dicey. And make sure if you're getting into a deal with a syndicator or a partner, make sure that you're asking all the right questions. You understand their background. You understand that they've been there before. You understand that they know how to stand up under pressure and perform when things are tight. Do your homework and be intentional with your investments.
Yeah, very sound advice. Very sound advice. All right, guys. Well, if you want to reach out to James, you can reach him via his website, PreReal.com. Check it out. And, by all means, if you're interested in doing any type of residential, commercial stuff, reach out to James. He's got a wealth of knowledge, as you can tell. Thanks for tuning in, guys. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.